I really am. I like that we're mixing it up a little bit. So you have the S&P at a record high. Let's see what happens in the next 8 minutes. But I think this would be the 16th or 17th record closing high of 2021. And I would just repeatedly point out that all of this is happening with some of the largest, most obsessed upon growth stocks in anywhere from a 10 to 15% drawdown from their peak prices, in many cases, peak prices that occurred months and months ago. So if you're somebody that is relatively new to markets, just instinctively, you would probably believe more stocks making new highs is better than just a few stocks. And that's exactly the situation we're in. You had this big cyclical rally. But now, here's what's interesting today. Now, large cap growth has entered the chat. And you take a look at the leaderboard today, and you have a lot of these names that are trying very hard to bottom, that have not been helping the rally so far, start to bust a move higher. And so that could be the next leg of a bull market for the overall index if you get more of that. So Square Up having a big day today. Shopify having a big day today. Zoom and DocuSign seem to be trading in lockstep. Those two trying to find a bottom. Both up 3% today. The ARK ETF is up 4.5%. So these stocks have not been helping. But if they start helping, look out. I think that's where the next leg could come from.
Interesting point, Barb. It raises the question of sector rotation, which has been a huge theme. If you look at what's leading us to a record high this year, it's very different than last year. You've got energy, financials, and industrials as the top three performing sectors. Is that where you want to stick? Are you adding to positions there? Or, as Josh was saying, are you buying some of the beaten down tech names that could take us on the next leg?
Yeah, well, it's an interesting point because I think we're going to continue to see this rotation back and forth between the value, pro-cyclicals, playing the economic reopening, because let's face it, there is a total consensus that we are in a major recovery economic reopening phase, and it's not undiscovered. The market is a discounting mechanism. And so what we saw with the secular growth names getting hammered, I mean, the valuations were extreme, and money had to come from somewhere. Plus, you had rising interest rates that compresses PEs on high growth names. But the money to buy into the stocks that are really going to benefit in the short to medium term had to come from somewhere. And that's typically been, we've seen this every year, stocks that have run up the most get hammered, often come back. Now, I don't see a lot of these secular growth names getting back to new highs this year. Some may, some will not, but I think they've been way oversold. And I think that starting out the next quarter, you're going to see a nice rebound. So if you're putting money to work, I think you can put money in this area while continuing to invest in some of the pro-cyclicals, whether it's a Boeing or a GM, which has the EV story. So it's I would do first, though, the oversold pro-growth or the oversold secular stocks.
Shepard Smith here. Thanks for watching CNBC on YouTube.